afternoon, and welcome to Thompson Hine's Coffee Chat webinar series. My name is Imani Tibbs-Boone, and I'm an associate here in the firm's private fund formation and new ventures practice groups. Thank you so much for joining us today, part of our ongoing Coffee Chat series designed to provide concise, practical, and timely topics impacting the financial services industry. Today's program is titled Private Fund Formation Deep Dive. This session is all about setting up private investment funds, whether focused on startups, trading strategies, lending, or digital assets. We'll compare common fund strategies, include setups where multiple funds feed into one main fund, side-by-side funds, or for different investor types, and the choice between US-based and offshore vehicles. We'll also explain the main legal differences and exemptions that let private funds avoid burdensome registration requirements. I'm pleased to introduce my colleagues who will be joining me today. Lindsay Kara-Stensel, a partner in the Private Fund Formation and New Ventures Group, as well as Daniel Pilstrup, counsel in the firm's Private Fund Formation and Investment Management Practice Groups. During today's program, we encourage you to participate by submitting questions through the Q&A box at any time. We'll address as many questions as possible during our conversation, and we'll follow up afterwards if we're unable to cover any of the topics. You should also see links on your console screen to register for upcoming Coffee Chat series. Finally, please note that this discussion is intended for the general information of individuals and organizations on matters of current interest. It is not intended as legal advice, and participants should not act on the information presented without seeking professional counsel. With all of that said, let's go ahead and get started with a brief overview of the private fund landscape. Traditionally, in our groups, we work on several different types of funds: private equity funds, venture capital funds, hedge funds, real estate funds or REITs, fund of funds, special purpose vehicles, master feeder funds, the like. We also includes representing our clients and all of the above, along with ongoing fund formation. And so with all of that said, let's talk about how these funds differ from one another and the key decision makers and what they should actually be considering as they get ready and start for the world ahead. So let's level set here a little bit, Lindsay. How do you think about the key differences in forming a venture fund versus a hedge fund, private credit fund, digital asset fund, and where are you seeing the most activity right now?
Sure. So excited to be here, and fabulous question and way to start us off. So when I have a client that comes to us and says, hey, I want to start a fund, my first question is very frequently, okay, please explain to me what your investment objective is. What is it that you are looking to do, and how are you looking to do it? And so once we can understand that and that baseline, and we can understand the size of the fund, it helps us to start to shape from a structural and a regulatory perspective, what is the best fit for that client? So example, if a client comes and they say, hey, I want to invest in companies that are just getting started and they need capital for expansion and growth, and they're in a very specific type of a sector, that to us would start to signal, hey, that is probably a venture capital fund. They're investing directly into the securities of an underlying portfolio company. They're looking to do that investment for expansion and growth. So that's kind of signaling to us that it's directionally heading there. Now, if someone comes to us and says, hey, I want to buy existing companies and I want to roll them up into one company or under a platform, then we're probably looking more at a private equity type of a fund. So there, in that instance, they're buying more often than not the secondary issuances, i.e. the securities that people own of a company, and bringing that under their umbrella, So that's going to help us shape that. Now, if someone comes to us and says, hey, I have this really great algorithm that I've built, and I'm going to do shorts on certain types of publicly traded securities, and I'm going to have a smattering of some private securities, we're probably going to look at that and say, hey, okay, you're probably a hedge fund, so let's dig into that a little bit more. And so really when we're listening, so typically if a client comes to us and has a phone call, that first phone call is often a lot of us asking questions, but most importantly, us listening to what it is that the client is thinking about doing, how they want to do it, and importantly, how much money they want to raise, because that could drive some of the regulatory overlay that we then have to consider.
Oh, that's very helpful. And I think, Daniel, maybe I would love you to jump in here. Regardless of the strategy and those differences, what are the biggest structural or even strategic decisions a manager needs to get right at the outset, regardless of whether it's a hedge fund, venture capital fund, et cetera?
Sure. And also very excited to be here and happy to be discussing fund formation matters. If you take the strategy out, I think the next consideration is what type of investors are you targeting? Are you targeting, large institutional investors? Are you targeting retail investors, maybe high net worth individuals, or even, mom and pop? What is your investor base that you're really going after? And the heart of that question really gets to what exemption is your fund going to rely on under the Investment Company Act, right? So if your target investor base are institutional investors that satisfy the qualified purchaser thresholds, which is $25 million for entities, $5 million for individuals. Then you can rely on Section 3C7. The number of investors coming in doesn't really have great bearing on your fund structure, and you'll have a lot of flexibility. If, however, you're targeting more retail investors, individuals, and they're not going to meet that qualified purchaser threshold, then you're probably going to have to rely on Section 3C1, which is for accredited investors. And if you're relying on Section 3C1, it limits the number of beneficial owners of the fund to 100. Now, 100 beneficial owners might sound like a lot, but you also have to apply certain look-through rules. And in my experience, even smaller funds will start to come up against this 100 beneficial owner limit. So that's something that you really have to consider at the outset when you're structuring your funds.
Yeah, and while you're here, I know that this crowd is super educated, and I know that we're all pretty much familiar, but I also want to just add, and maybe if you could shed some light on this, Daniel, just the differences between an accredited investor, qualified client, and qualified purchasers. I know you mentioned that in your response.
Yeah, so qualified purchaser is $25 million in investments for entities, $5 million in investments for individuals. And then there's, trusts and other, investors that might not fall squarely within these thresholds. And then you should really kind of talk to your counsel as to how to handle those. For an accredited investor, it's $5 million net worth for entities, $1 million net worth for individuals, or income. It's $300,000 joint income with a spouse, or $200,000 income for an individual. So that's the accredited investor threshold. Qualified client, I'm going to talk about a bit about that later on. But in general, it's $1.1 million in assets under management with that specific manager, or it's $2.2 million net worth.
Thank you for that context. And it may seem like I'm picking on you a little bit, but just bear with me here. Could you also maybe shed some light on the most common fund structures that you're seeing today, particularly master feeder, parallel funds, or offshore vehicles, and maybe add some context about when each type of structure would be most appropriate?
Yeah. So, all of these fund structures are still common in the market. One of the very first things that I learned in fund formation was that tax drives the bus on structure, right? So every structure that you see is really designed to achieve the most tax efficient arrangement that, for both the investors and the GP. Really the structure that you're going to use is going to depend in large part on what the tax status of your investors is. And so, in particular, many funds will set up blocker corporations so that the investors that are coming in will not realize, kind of this pass-through income, which can increase their tax liability. So specifically, it prevents the flow of what we refer to as UBTI, which is unrelated business taxable income, and ECI, which is effectively connected income. And these blockers, they can be set up in parallel fund structures. They can be set up in master feeder structures. So, it really is going to be fact specific as to how you set up the fund structure. But I think the important takeaway is that when you are considering fund structure, talk to your tax advisors and see if that structure is going to affect both the tax status of the GP as well as incoming investors.
Absolutely. And I know we work really closely with our tax folks here at the firm when we're forming funds and even when we're representing investors to just make sure that we're getting those considerations just right when it comes to structure and even just, again, representing the client as an investor. So I'm going to shoot it over.
I should mention is, there's after tax and there's also regulatory considerations. And I want to touch on this because we talked about the 100 beneficial owner limit under Section 3C1. And if you are coming up to that limit, you might get the idea that, hey, I'll just form a parallel fund and we'll just have 2 parallel funds and each parallel fund will have 70 investors and we'll be fine. That is not going to work. Many people have tried and the SEC has come down very hard on fund managers that attempt to do this, including, restitution of management fees and carried interest, as well as financial penalties. So, what you can do, however, if you do end up in this scenario, is if you have a mix of accredited investors and qualified purchasers, you can form 2 parallel funds, one fund that relies on Section 3C7 and the qualified purchaser threshold, and then another fund that relies on Section 3C1 and the accredited investor threshold. So that is an option for you. But just forming 2 parallel funds and then saying, hey, I'm under the 100 beneficial owner limit is not going to work.
Yeah, despite our best efforts, they're pretty, there's a lot of scrutiny, we'll say it that way. But, and I know we could trade war stories all day, but Lindsay, I'm curious to know from your perspective, how should managers think about US versus offshore structures, especially when targeting a global investor base? I know Daniel mentioned a little bit about how we can get creative and maybe setting up parallel funds, but what happens when we want to go offshore?
Yeah, so there's a couple of things that will go back to the analogy of driving the bus. Where are the investors located? And then again, tax. Because depending on where the investors are coming from and how they are taxed, i.e., are they taxed under the American tax system or are they taxed in the EU? Are they taxed somewhere in Asia? And so depending on those questions and where they're located, it might be more efficient for the parties, the investors involved, to be saying, okay, we want to set up, everyone has kind of heard like, oh, the Cayman Islands, set up a Cayman feeder fund. We'll set up a Cayman vehicle. Bermuda is another place, depending on when you're thinking about setting up these vehicles, is that a place that's more efficient or effective? Also, Luxembourg is another one that people will often think about domiciling in, and then setting up funds below that fund will lead into, so that they can then invest in US-based organizations. So ultimately, the times that we see the master feeder structure, particularly with relation to foreign investors, is because those foreign-based investors do not want to then become subject to the U.S. Tax system. So that is ultimately what is driving us when we're making those decisions. And so sometimes once we find out, hey, we've got some investors that are based, in Singapore or, Japan, and they have said they want to do a different structure, then we start looking at those other offshore locations.
Thank you. Thank you. Thank you both. And here's a question maybe that either one of you could field, or both, please, by all means. What are the biggest mistakes? And I know you talked about war stories. What are the biggest mistakes you see emerging managers make when selecting a structure? I know we know that tax drives the bus, your investor base drives the bus. But at the onset, what are the most common mistakes that you're seeing, and how costly are those mistakes?
Yeah, I'll go first, I think. So, there's a handful of things that people could make mistakes on, but typically when we are working with a general partner who's saying, "Hey, I want to establish a fund," we ask them a lot of questions around how do you want to run your business? How much control do you want over decision making? How much authority do you want to give the limited partners to make decisions, and if what decision, what decisions might those be? Then we also ask, hey, what does your investor base look like? Do you have anyone who's got a very large controlling position or a very large anchor? Because oftentimes what we will see is when someone is getting started, they've already started talking to an anchor and they've committed to the anchor, hey, we're going to set up a structure, we're going to allow you to have some level of veto power over certain investments, or we're going to commit that you get 25% of the carried interest, not just in this fund, but in all funds created by the general partner into perpetuity. And those are things I just don't think you need to give away. And a lot of times people they're getting excited because they've got someone who's saying, hey, I'm going to stroke a check of 20, 25, $50 million. And that's a significant position for someone to be taking in a fund. However, that doesn't mean we have to give them the sun, moon, and stars right off the bat. Maybe as part of the negotiations as we go through it, we find that there is something that we want to give, and that's totally reasonable. But just jumping into giving up control, and then does that control create some sort of dynamic where that LP is no longer actually truly a passive limited partner? And then what issues do we have to look at there? And then more significantly, a lot of folks get into the fund world, management fees are nice, but it's the carried interest, promote, performance fee, however you want to talk about it, that is why people are doing the thing that they are doing. And when you've committed to give huge chunks of the carried interest out, in the future, and not just in this fund, but in future funds, you've really kind of shot yourself in the foot. And it's a really hard thing to try to put back in the box once it's come out of the box. It's like shouting out, hey, I want to get a divorce. Like, it's really hard to pull that one back in, right? So, and similarly, like when we say something like this, it's very hard to get the anchor to forget that we have committed to something like that. So I would say for me, those are some big structural snafus just from a business operational perspective. From a structural perspective, I think once in a while you see some folks that kind of take documents that have been used at, colleagues' funds or similar vehicles and think that they can kind of do a copy and paste run at it that way and start a fund vehicle, and haven't really thought through some of the issues, particularly securities issues that they need to be worried about. And as a result, haven't done filings, haven't, done a Reg D or a Form D filing. They haven't notified state entities that they are doing business in their area. So those things, I think, from a high level, are some of the real messy bits that we'll get to see. But Daniel, always curious on your position on this too.
Yeah, no, those are all great points. Definitely be careful what you put in a side letter, because you may have other investors that are going to see that side letter, and you can end up negotiating against yourself with other investors. I'm actually going to stray a little bit away from fund structuring because I think, at the outset, the fund managers are so focused on structuring and fundraising. And obviously these are, critical areas for the fund, but then they forget that they're actually acting as an investment advisor, and they're going to be subject to some level of registration, whether it's at the federal level or the state level. And so not to lose sight of the fact that at some point you're going to need to register as an investment advisor. And if you have to do a full registration, you're going to probably want to do a filing before your initial closing, so that on your initial closing, you have the license to act as a fund manager. Whether it's at the federal level or the state level, full registration typically needs to occur on or before the initial closing. The other thing I would note is, and Imani brought this up earlier with respect to qualified client status, if you are a fully registered investment advisor, then you're subject to rules that require that your investors meet a qualified client status in order to charge a performance fee. So in order to get that carry from your investors, they all need to be qualified clients, not just accredited investors. And I think that's something that can get overlooked early on in the process. And then, you get towards the initial closing, you're like, wait, this could actually be a real issue from a regulatory perspective.
Yeah, I think between the three of us, we've seen a lot. You all certainly more than I have in that respect. But I think if I could summarize it, it's almost like our clients come to us and they're excited about their thesis. They're excited about their strategy. They're excited about this anchor investor and, sprint right out the gate. And so to Lindsay's point, you don't want to really say anything that you can't take back or walk back later. And I think one of the very cool things about working in this space is because we get such a variety of theses and strategies and the like, we get to really surgically create a world through documentation and filing and in regulatory exemptions where our clients can thrive and do all the things that they're excited about. But I think it sounds like maybe we should have a little bit of space to be able to do that at the beginning. And I know, like I said, we could trade war stories all day. My eye was twitching a little bit as Lindsay was talking. So I understand that. I know, Daniel, you've talked about this concept of regulatory exemptions and frameworks a lot throughout this discussion, and I kind of want to kick it back to you here. We've worked together on a number of funds, and we've kind of crafted regulatory frameworks, strategized with the clients on what would make the most sense and how it would work best. Can you take some time and break down the key exemptions managers are using today, what you're seeing just in the space and where you're seeing increased scrutiny?
Sure. So the main exemptions that fund managers use are first the private fund advisor exemption. And this is for any private funds up to an AUM of $150 million. But it's important to know that if you're doing that the requirement is that you have to only be managing private funds. So if you have any managed accounts in there, you're not going to be able to rely on that exemption, and then you're going to be subject to some level of full registration. The other common exemption is the venture capital advisor exemption. And the venture capital advisor exemption is not limited in terms of AUM, but the definition of a venture capital fund is quite specific and narrow, right? So as Lindsay actually mentioned earlier, you have to acquire the vast majority of the securities directly from the issuer. You're restricted on your leverage and other investments. So there's a lot of considerations that go into whether or not you're able to rely on the venture capital advisor exemption. Other than that, there could be some other exemptions that you look to, but if both of these exemptions require that you're only managing private funds, so anytime you're managing other accounts, there's a very good chance that you're going to be subject to full registration.
I know that we're seeing increased IRS scrutiny. We're going to just drop in another agency here related to valuation and calculation of fair market value. I think that's pretty sensitive when we talk about carried interest and how managers are making their money and making those returns. So Lindsay, let's talk about, this is a recent regulation or a recent uptick that we're seeing maybe within the last 6 months. So I would love to hear your experience with that. And also just what you think most fund managers should be considering at formation and an ongoing basis to ensure compliance with those specific regulations.
Yeah, so when you are starting a fund, and many of you out there probably know this, but oftentimes when we're starting a fund, we're thinking about on the back end of that and on a quarterly basis, on an annual basis, we're talking about preparing financial statements, and on the annual basis, we're auditing those financial statements. And so, if you're thinking about starting a fund, if you're out there and you're listening for that reason, there are a lot of costs and a lot of additional steps and processes that you have to be thinking about, particularly if you have institutional investors. More often than not, they're not going to let you waive those audit requirements. And so those can be pretty expensive, even on the most, simple of funds, with a very standard investor base and structure. You're still looking at $35,000, $40,000 a year on a straightforward audit. So, but as part of that audit, something that's come about in the last roughly year of time, as part of the auditing standards. So going back to, I think it was 2011 or 12, I'm dating myself here. We didn't used to have to do this, but you didn't have to used to value your portfolio on a quarterly or annual basis. And then we, back in the day when Google was going public, I believe, and CalPERS was part of that deal. And they sold some of their position in Google because they wanted to keep moving, because they just kind of said, hey, like, we've been in this for a minute. And then 6 or so weeks later, Google announced that it was going public. And so CalPERS took quite the hit on it cost them something north of $1 billion and to their investors. So it spurred this need to get what we call do FAS 157A valuations on at least an annual basis. And so as part of that process, there's been some ever changing set of standards. The most recent being, as part of your valuation process and as part of those financial statements, you do have to show your internal rate of return on your audited financial statements now. And so whereas before there was, you could kind of talk about your companies and say, hey, we've got these great up rounds and we've got these term sheets and, rah, things are going great. And we think we're going to sell this part of the platform to XYZ. Now we do have to be showing the internal rate of return to the investors on those audited financial statements, which then also impacts, if anyone is, if anyone's fees are somehow conditioned on some of that, they might be negatively or adversely impacted. And plus it makes it a little bit harder to say, hey, like, IRR is calculated however we're calculating it internally. It's now governed by these auditing standards. And so it has sort of changed the world of, particularly in the venture fund and the private investment space, how those entities are being valued and shown on a pure fund management basis. So I think more to come. I think if you want opinions by LKS here, I think it's added an unnecessary, to some degree, burden to the fund managers who have to take that process on because they're already, trying to grow these portfolios, and there's a little bit of marketing and gamesmanship about it. So I think it's made it slightly more challenging for them to not just do their job, but then raise subsequent funds as a result, because their IRR on that audited financials, if they haven't had exits yet, is not showing as something that's super strong, particularly in years 1 through 4.
Yeah, and you touched on this a little bit in this last response, but valuation had traditionally been gamesmanship, a little bit of marketing, very much strategy specific, and almost what made in the most legal and compliant way, almost what made fund formation and private funds fun, right? So now as we move forward, how should fund managers align valuation policies and redemption terms with the underlying assets, particularly for less liquid strategies like venture or private credit, and in light of some of the new changes over at the IRS?
Yeah, I mean, I think understanding your strategy, if you're a fund manager, is an incredibly important thing, because if you're investing, if we're going to pick on venture for a second, if you're investing in what we call the pre-seed stage, which is in one of the earliest stages of venture capital, you can expect that you're going to be holding those investments oftentimes for 10 and 12 years. And so thinking about the structuring of those portfolios, how do you think about layering in entities that are investments that might exit slightly earlier or provide some levels of liquidity or options to take some level of capital off the table at a sooner point in time? A lot of times we'll see with institutional investors, they say, okay, well, we want to know that you are seeking redemption abilities with you, or you have the right to seek redemption abilities of your underlying portfolio investments in 5 years from the date of investment or 7 years from the date of investment. Naturally, that causes a rub then with those portfolio companies because they are trying to grow and expand. And, you know, when we were looking at 2010, 2012, the problems were smaller and could be solved quicker and with less cash. Now, on average, it takes something like $400 million to get a company to a state where it could be acquired or IPO. And that's also happening over a period of about 7 years. So expecting a liquidity event in 5 years is a really challenging thing. So thinking about how you're structuring a portfolio is important. Thinking about how you're layering on the opportunity to maybe redeem some of your position in a company or multiple companies is probably important. And then thinking about your valuation policy, you know, oftentimes valuation policies, they're managed at the management company level, and they're the same across the portfolios and so, for the types of entities that you're looking at. So often debt is held at cost, and not even inclusive of interest. You're showing the interest on the books, but you're not marking that position up. You're marking it as debt until it's been repaid, absent a material write-down type of event. Now, on an equity position, you can mark your asset value to cost basis, which, if you've been holding for a long time, is not helpful for IRR and raising subsequent funds. You can mark it to market comparables, which, if you're in a new industry, how do you figure out where you're marking to? You can mark to market, which is usually where people are going to go and say, hey, what's the most recent transaction that's happened at this company level that's just demonstrating the value? Or lastly, we could do a discounted cash flow, which is going to effectively demonstrate a little bit of guesswork. And it's not exactly the easiest thing to get past auditor scrutiny. Those are the ones that get looked at pretty intensely under technical review at the auditor level. So kind of thinking about how you're layering on different companies, how you're layering on abilities to get out, and how you are layering on the ability to possibly find some additional liquidity while still valuing your portfolio in a reasonable way it's a science and it's an art, right? Like, this is where people make their real money, and it's not getting any easier. It's getting harder all the time because it just takes longer to get out of these companies. It costs more to get out of these companies. And unfortunately, the 2019 to 2022, mid 2022 timeframe caused a huge liquidity crunch that we're still seeing today. So it's just really hard right now to do this and do it really, really well.
Yeah. No, that's actually very helpful. I know we're about halfway through our program today, and so I want to encourage any attendees who have any questions as we continue forward, or anything that we've said previously, please feel free to drop them in the question and answer box. And if not, we will continue going and rolling at the speed of light, because that's what we're here to do. All right. So, Daniel, this is a fun one. I think we've worked on a couple of funds together that have used this as a strategy. And so I'm curious to know, along with some of the updated reporting requirements that we talked about, and of course, always the regulatory framework that we should be considering, we're also hearing more about tokenized fund interest. And so from a practical standpoint, how are you seeing tokenization being used today? Is it more hype? Is it science and art? Is there real adoption happening there? And are there any legal or operational challenges that fund managers should be excited about before selling the entire portfolio off to Bitcoin?
Great question. I will say that, it's still kind of the wild, wild west out there. There is obviously just massive hype behind tokenization of funds. Even certainly the current administration is behind it, but even like the regulators are pushing for innovation in this area. The head of the CFTC in a recent interview said that he expected, the majority of capital markets to be on chain in the next 2 to 5 years. Now that seems a little aggressive to me, but it kind of just underscores the fact that there's this massive push towards digitization and the switch towards on-chain, financial markets transactions. In terms of reality, we are seeing adoption of tokenization, but the floodgates haven't opened, right? There's still a lot of operational considerations. The potential is great, right? If you can move so many of your fund operations, integrated into a smart contract, make them automated, right? You could do reporting, capital calls, distributions. This could all be automated through smart contracts on chain. But I think there's also an uplift there, right? Like the private fund space is, a relatively mature market at this point. The processes are baked in. They've all gone through, countless levels of negotiation and scrutiny, and so all the fund managers in the market typically they're very comfortable with the process, and investors understand the process. So going on chain introduces a number of unknowns. In terms of operations, I think it's important to bear in mind that there are these great efficiencies that can be achieved, and we're getting more regulatory clarity, but this is still not an unregulated space, right? Just because you've turned a private fund interest into a token doesn't mean that it's no longer a security, right? So, we've gotten some guidance on that from the SEC and CFTC recently, but you don't automatically lose kind of the regulatory burden by going on chain. You still have to comply with your standard fund regulations and investment advisor regulations. So all to say, we've had a lot of experience with moving funds on chain, but I wouldn't say that this has been a widespread market adoption at this point. But it'll come back in 18 months and we may see that the floodgates are open. So
yeah. And typically when we've worked on funds like that, these advisors are very well versed in the technologies and the use cases with cryptocurrency and tokenization and things of that nature. And so typically those investors are also very sophisticated in that respect. I will say, just from my view on the ground here, so the difference between your standard hedge fund or just private equity fund and the disclosures that you would have to provide in a tokenized fund are massive, and those documents just seem to go on forever and ever and ever. But it really is accounting for, to your point, just the fact that it is the Wild West. And so making sure that as you're advising and going out to the investors, that those risks are allowed, they're very clear, and that we're being very explicit in the fact that it's a for lack of a better term, a largely unregulated space. So but everyone's excited about it. Everyone's excited about it, Lindsay.
Yeah, and I mean, I think people get very excited about it because, especially people who are trying to set up these tokenized structures. However, I think another thing people need to keep in mind is that you have to sell this to someone, right? So it is hard enough oftentimes to sell, hey, this is my private equity structure, this is my hedge fund structure and thesis, this is my venture fund thesis, and this is why you should invest in me. It's hard enough sometimes to get investors to go pay attention to you and understand what it is that you're actually doing, and then layer on this additional level and oh, now I'm going to tokenize it. And people's eyes glaze over, right? So I think there's also a reality of helping people to understand what it is that they're even investing in, and trying to help our clients figure out what's the best way to express this when they're trying to sell it to a potential investor, and do so fully compliantly.
Yeah. We've got a question actually from the audience from Jeffrey Evans. He asked, are there any salient challenges facing firms that use private credit strategies? I know we talked a lot about private equity and debt offerings, specifically private credit and its offerings, especially interval funds.
Daniel, you want to take it, or you want me to take it?
I always found that valuation is different in private credit. And that really kind of goes towards how you're marketing your performance. And this can really attract SEC scrutiny. So, making sure, as Lindsay had said previously, that you have, very clear valuation policies and you're following that. That's going to be clear when there's regulatory scrutiny, on what you're providing your investors. But I don't know, Lindsay, if you have other thoughts.
Yeah, I guess, one thing that, we do see and then we run into or could run into issues with is, which is why we try to counsel our clients to be very thoughtful in this, is when it comes to those interval funds. If people are able to roll in and roll out, and we're looking at the NAV and saying, hey, what is the value at the day that someone says, I would like to take a portion of my money out? Well, we're hearing a lot of, and I don't think we're seeing too much of it. I mean, we've had a few clients that have said, hey, we've got some folks who want to redeem part of their position. But the best thing to do when you're thinking about structuring a vehicle where an investor can redeem some or all of their position on their choice, their elective, is to think about what are the gating mechanisms and the timing of which we allow them to take that money out. So, some folks come and they say, well, if someone wants their money out, like, I don't want to hold them their feet to the fire and keep them in when we're going gangbusters. Well, you're going gangbusters right now. There is a reality and a world where things change and you no longer are, and all of your investors come to you and say, I would like to take all of my money off the table. And now you have to figure out how are you creating liquidity to be able to do that thing. So one of the biggest things we think about in that sense is, hey, when is the strike day of when you're calculating the NAV? And then when are people and how much of a percentage of the position are people allowed to take out over time? And then if we're able to negotiate it in, we also try to negotiate in whether or not we can allow general partners to say, hey, like, it is not in the best interest of the fund at large to be allowing for a redemption at this point in time because it's harmful to the other investors. So we kind of think about it from that perspective. I mean, with private credit, yes, the valuations are an issue. Layer on top of that the marketing of that at large right now. If you're paying attention to, Financial Times or whatever else and saying, hey, we're seeing a run on private credit, it causes people to get nervous. So that's why we try to caution people to be thoughtful about that right at the onset.
Yeah, I find in the couple of interval funds that I've worked on, I find that we play more of a therapist role in really encouraging those advisors to say, let's think about not just the redemptions, but also sticking to your guns on those redemptions. And so if someone comes to you with $1 billion to invest, but wants to remove all gates and holds and all things kind of implicit to an interval fund, really encouraging our clients and as fund advisors to stick to their guns, keep those redemption terms in place, and making sure that, to Lindsay's point, that it's blue skies and sunny today, but should the tides turn, you want to make sure that there's still capital in there to make sure that you can operate and continue to affect your strategy. But those are some of my favorite clients. So if I do say so myself, not that I have a favorite client, if I'm impartial, certainly, but okay. So we've talked a lot about strategy. We've talked a lot about structure. And I think maybe pivoting here a bit to fundraising and investor expectations. I know, Lindsay, you've talked a lot about, marketing and really understanding how to sell the fund, whether it's a traditional fund or some novel strategy that folks are working on. So either of you can field this question. What are we seeing that's working in fundraising? I know it's a crowded market. There are new asset classes being created every day. Everyone is thrilled with that, whatever their asset class is, and wants to be the early adopters and the biggest funds and the most public, or whatever the case may be. So in a crowded market, how are managers successfully differentiating themselves? Any reporting or regulatory frameworks that they should be aware of? I'll let you guys have at it.
Yeah, so I'll take this maybe first. So talking to one of my dear investor friends, I actually asked this question of him. I said, the market's been kind of hard for folks to raise money, and it has been because of the liquidity crunch that I have mentioned that's been rolling forward into today. So between 2019 and 2022, money was effectively free. Lots of folks were throwing money, all over the place, and that has not necessarily borne fruit in a lot of areas quite yet, and it might not ever. So that makes it just harder to raise dollars. And so I'll kind of talk about emerging managers, and I'll talk about existing managers. So real quickly on emerging managers, it's a harsh road out there. It's a tough go. So you have to really be making sure that your network is really deep. If you have something that you can point to as some level of track record, be it as individual investor, as part of another environment, or you've just got the most compelling story of stories to be able to close something, then I would say, hey, okay, probably going to be able to do it. Might not be as big of a fund as you might have thought it might have been at the onset, but you could probably squeak it out. For our existing managers, the best thing that's going to help you raise money in a second fund, third fund, 10th fund is returns. And people want to see that you have a strong MOIC and a strong IRR. They want to know if they are going to tie their money up for 7, 10, 15 years, that they are going to make a ton of money on it on the back end. And so, I think working with companies, this comes back to the strategy, the portfolio construction of these different funds. The more that you can kind of layer in entities that, you've got some exits that are quicker and strong and create a good story and help you build momentum. And then you can also layer on top of that, hey, are we seeing growth in the portfolio, and true growth, coming back to those valuations where they're mark to markets, where there was a true write up in valuation? Is the company, that some of these portfolio companies, are they in a really truly growing industry, or is it some of the proverbial smoke and mirrors and there's not really a there? And so returns solve all things. And so if you are it's just like sales solve all things for underlying portfolio companies. If you are returning capital and you can make a story out of that, you have to be able to time that really well to be able to capitalize off of it quickly before that information becomes too stale. But the sooner that you can start to flip that and turn that into your next fund, and it is a legitimately good story, I think the better. And one more layer here. So emerging funds are typically classified as funds 1 through 3, which I disagree with. I think it should be funds 1 and 2. Those are still, you're emerging, you're trying to figure it out. Once you get to fund 3, you aren't raising fund 3 unless you had some strong returns on fund 1 or fund 2 or both. It's just you can sell fund 1 on hype and excitement of thesis. You can sell fund 2 on the underlying portfolio of fund 1 and how you're going to do it again. Fund 3, you are not getting those big institutions. You are not getting those ultra wealthy qualified purchasers like Daniel was talking about, unless you can demonstrate that you have returns. Last point on this, a lot of organizations, the institutions, now have a mandate that they are not permitted to even invest in a fund that is earlier than fund 3 anyway. And so the only way that you're going to get those dollars is that if you have returned dollars and you have survived to fund 3. So it's tough, but I mean, if you're diligent and you're, using some of these tools that we've been kind of alluding to, and you've got a really great thesis and you've produced those returns, very, very doable thing, but it takes time.
I think the only thing I would add is, I think sometimes people think that engaging a placement agent is going to solve all the fundraising issues. And that's just not the case. Not only is it, there's no guarantee it'll be effective in raising more funds, but it's costly. It's costly both from, the fee that they'll charge, but also from a regulatory perspective. And they'll often try to negotiate terms that will last not just for this fund, but that will last into future funds. And so it's important that if you do decide to move forward with a placement agent, to really have your counsel review and engage on the negotiation of the terms of the arrangement.
And one more point on this. Let's make sure that they are registered to be able to do that thing. I can't tell you. I mean, it is very easy to go look them up on the SEC website, right? To type in, hey, what is this organization? Do they have any dings against their record? Are they actually legitimately licensed? Because if someone has helped you raise money and they do not have a license, there can be some pretty strict and harsh realities that come with that, to and include rescission for all of the investors that were brought in by, and it's not just rescission at a point in time, it's actually rescission for the duration of the fund. So if you're a gamesman or a gameswoman, you say, and you found out that you got brought in by some unlicensed broker, you go, well, I'll sit and watch. I don't need the money today. But if the fund starts to go sideways, magically you need the money back, right? So it is a slippery slope if we don't just do a quick Google search to find out that these people are or are not licensed to do business legally.
Yeah. Oh, thank you for that. That is very important. And then maybe on the flip side, it's the perspective is always good. What are sophisticated investors asking in diligence in 2026 that maybe they weren't asking a few years ago?
On due diligence, I think a lot of things remain very similar to what they've always been. People want to understand, what are your past returns? What does the underlying team look like? But I do think now you see, we can't make it through a presentation without talking about AI. So enter AI into the chat. So, now people want to understand, hey, what AI-based tools, functionality are you using for the benefit of the investors? What are they using for access to reporting? What are they using in terms of platform to monitor the portfolio? And how are they doing due diligence utilizing AI? So I think maybe we see some more of that, but a lot of the stuff just remains the same, which is actually funny because sometimes you've got investors that dive in for 6 months, 9 months, scrutinizing everything, and they've got these incredibly long DDQs, due diligence questionnaires, and then you've got others that are just investing based on vibes, and they just do investments based on liking someone. Yeah. So I think there's a little bit of everything.
Daniel, anything on your end?
Nothing to add there, yeah.
Nothing new. Okay, yeah, fair. I think it's pretty standard as well, and someone who's usually fielding those requests, it's at this point, it runs the gamut, and you just kind of roll with the punches. And again, if we're thoughtful about how we set up a fund on the onset, those are, we can handle from the most scrutinizing to the laissez-faire, all as well. We're almost at time here, and so I want each of you to kind of give me 2 big takeaways for emerging managers in the audience. What is the first 2 things that you would prioritize in the first 90 days of starting up a fund that they can take away with them as they go on their journey today?
Sure, I'll go first. So oftentimes we have, when emerging managers come to us, so we do have an emerging fund managers package, which allows us to sort of walk a fund manager through the 6 primary steps of what it takes to launch a fund vehicle, and gives them some estimates on costs and things of that nature. But I think in order to make that work, part of it is we have to slow down to speed up. And so I often encourage fund managers in their first 30 days is to really understand who's going to be part of your team and who's doing what, who's going to be getting what, and iron out some of those messy bits of the general partner agreements. And we don't have to paper them just yet, but we need to know directionally who's getting what and who's going where, and who's in charge, and what are, how are we going to be allocating carried interest and things of that nature. I also think we need to just, level set in terms of everyone on that general partner team needs to be on the same page. And everyone needs to understand that funds are not closing in a 2-week, 3-week time frame. It's just not a reality. We can get the docs drafted, sure, no problem. That's not the issue, but it is, then sure, we drafted it, but if you're presenting it to an investor, particularly an institutional investor, they're going to have comments, they're going to have thoughts, they're going to have markups to that. And that takes time, and it also just costs real money. And so making sure that you're thoughtful about your investment strategy, you're thoughtful about how you want to approach working with these investors, and thoughtful about what are the things that are must-haves for you in running your organization versus like things that you could give on because they maybe matter more to an investor than they matter to you. And the sooner you can get your arms kind of wrapped around those things, the better the process is going to be and the more cost efficient it is going to be. Because I think sometimes, emerging managers get sticker shock when they see, holy smokes, I have a plain vanilla fund here and this thing cost me 150 grand to get started and it took me 2.5 years. And it's like, yes, it did. that's how long some of those things can take, because the investment world is a tough place, and especially for those new managers. So, those are the things that I would kind of caution people to be thinking about. But Daniel, always curious on your perspective here too.
Yeah, and when I think about the first 90 days, maybe after launch, I think there should be a real focus on operations. Getting the procedures in place for how you're going to manage this fund, how you're going to correspond with investors. And then, and really the goal here is to ensure that your operations track what is in the legal documents, right? You're doing things consistent with the LPA, you're doing things consistent with the PPM or whatever other disclosures you've made to investors. This is an area it's a high risk area, both for litigation and regulatory scrutiny. So you really take the time to ensure that your operations match what's in the documents.
I think that's beautiful. Thank you. Thank you. I'll give it one last call for questions, and certainly happy to field those as they come in. Of course, if you feel free to add them to the Q&A box should you have them. If not, I'm happy to conclude today's coffee chat session. On behalf of Thompson Hine, I want to thank everyone for joining us. We hope you found the discussion informative and that you'll continue to join us for future sessions in this series. Please keep an eye out on your inbox for invitations to upcoming programs. Our next coffee chat will take place on May 13th, and it's titled 401k Investment Revolution, DOL Alternative Assets Proposed Rule. If you have any follow-up questions or would like to or additional information about today's topic, please feel free to reach out to us directly. And again, thank you so much for attending, and enjoy the rest of your day.